Welcome to my YouTube channel on long-term investment. This is about managing your money and securing your future. In our last video, we started with candlestick patterns and we are going to continue the same in this video too. So what does the pattern represents? The candlestick pattern gives visual presentation of traders' mind and psychology. Technical analysis is not only about the future prediction, but also about understanding price behavior. It helps you understand first thing, smart money moves, breakout or breakdown of the trend, reversal points of existing trend, and the trend build up before next big move. So I want to show you one chart related to smart money moves on the recent ITC stock. This is the ITC stock. It is updated until 23rd of January 2026. And you can see chart shows from June, July onwards. It is updated from 2007 onwards, but on the screen you can see from June onwards. So June onwards, the price was trading between range of 425 and 395. But somewhere in November and December, price started trading within the range of 400 to 408 only. So this was the period. And then on 1st of Jan, government declared excise duty hike on the cigarettes. And suddenly ITC dropped from 402 to 360. So this was the period when insider knew that something was coming up from government side. And institutional investor must have kept aside. Otherwise, you can see the volume also. Here you can see the volume from this period. It was very subdued. And see the volume before that. So the volume, the trading range tells you something is cooking in the ITC stock. So similarly, technical analysis tells you about breakout or breakdown of the trend or the support and resistance. Then it tells you about reversal point of existing trend and trend build up before the next big move. So in this video, we are going to cover up hammer and hanging man reversal pattern, engulfing pattern, and Harami pattern. So we are going to cover up the reversal candle pattern in this video. This is a hammer and hanging man. So basically, this is a hammer only, but where it appears on the train, either it is called hammer or hanging man. You can see these two figure 3.1 and 3.2. The hammer and hanging man are each made of single candlestick lines. They have long lower shadows and small real bodies that are at or very near the top of daily trading range. So you can see it here. They have the small real bodies and very long shadows. The hammer occurs in the downtrend and it is so named because it is hammering out the bottom. Here you can see this hammer. This was the downtrend in the market. And somewhere at the end of the trend, we can see that there was a hammer happening. So here it is hammering out the bottom. From that day onwards, if there is a white bar next day, the trend might change for short term. Similarly, the hanging man occurs at the top of the trend or during an uptrend. So here you can see this is the figure 3.2. There was an uptrend in the uh, market and the prices opened gapped up. They moved little bit and then they have come down and then they have closed at the very top of the this one price chart. So a hanging man occurs at the top of the trend or during the uptrend. The name hanging man comes from the fact that this candle looks like somewhat like the hanging man hanging. So that is why it is called hanging man. So these are the two candles are same, but where they appears based on that it is called either hammer and hanging man. And these are the short-term reversal patterns. How to recognize rules for recognition of hanging man or hammer. The small real body is at upper end of the trading range. Then the color of the body is not important. So the upper range of trading range there is a small body. Color of the body is not important. It could be green or red or white or black. The long lower shadow should be much longer than the length of real body, usually 2 to 3 times. And there should be no upper shadows, or if there is, it should be very small. Yeah, there should be no upper shadows. If it is a big shadow, it will become the doji and not the hanging man. Hammer. The reason behind why a hammer happens and why it is called the trend reversal from downtrend to uptrend. The market has been in the downtrend, so there is an era of bearishness. The market opens and then sells off sharply. So here, however, the sell-off is abated and market returns to or near its high for the day. The failure of the market to continue the selling reduces the bearish sentiment, and most traders will be uneasy with any bearish position they might have. If the close is above the open, causing white or green body, the situation is even better for the bulls. Confirmation will be higher open with 8 or still higher close on the next trading day. So this is the logic behind hammer. Similarly, the logic behind hanging man. For the hanging man, market will be an uptrend. In order for hanging man to appear, the price action for the day must trade much lower than where it opened, then rally to the close near high. This is what causes the long lower shadow, which shows how the market just might begin a sell off if the market opens lower the next day. There would be many participants with long positions that would want to look for an opportunity to sell. If the hanging man is a bearish, might be that body is black and the next day opens lower. So this is the hanging man. These are the examples. So here we can see the trend was in place. There was a downtrend here until this point, and here this bar. It it exactly represents the hammer, and from that another 2 or 3 days, the trend has turned up into uptrend. So this is the classic example of hammer. Here we have an example of hanging man. So here we can see the previous trend was up, and here this is the uh, hanging man which appeared, and after that, for short term, there was a change in trend. So here it has gone into the downtrend. So these are the classic examples of hammer and hanging man. Now next pattern, engulfing. So as words suggest, the engulfing pattern consists of two real bodies of opposite color. The second day's body completely engulfs the prior day's body. So here you can see there was a downtrend in the market, and then there was a big black body. But the very next day, the prices open slightly lower, but they keep pushing up, and the whole white body appears, which actually bigger than the previous day's black body. Similarly, here the market was in uptrend, and then there was a small white candle. But next day, the prices open slightly high at this point, but they keep going down, and this body engulfs the previous day's white body. So that is why it is called engulfing pattern. Rules for recognition: how to recognize whether it is engulfing pattern or not. A definite trend must be underway. So there should be a trend, either uptrend or downtrend. A second day's body must completely engulf the prior day's body. This does not mean, however, that either the top or bottom of the bodies cannot be equal. Okay. The first day's color should reflect the trend. So if it is a downtrend, the first day color should be black. And if it is uptrend, the first day color should be white. The second real body of engulfing pattern should be opposite the color of first real body. So if it is a black body, the next day should be white. And if it is a white, it should be black. These are the classic examples of engulfing pattern. Here you can see the downtrend was in place, and here there was black body, and then next day it opened lower, but it turned into white body, or the up day, and then it has entered the previous day, and then the trend changed into uptrend here. Similarly, the uh, engulfing pattern on the uptrend. So here you can see the securities were slightly in the uptrend, and then there was a big move from the bulls to push the prices up. But on the third day, there was a big black body which covers the previous day's white body, and then trend had shifted to the downtrend. Next is the Harami pattern. So it is slightly opposite of engulfing pattern. The Harami pattern is made up of opposite arrangements of days as the engulfing pattern. Harami is a Japanese word for pregnant or body within. So this is also called the inside bar. You will find that in most instances, real bodies in the Harami are opposite in color, also like engulfing pattern. And how to recognize? A long day is preceded by the reasonable trend. A color of the long first day is not as important, but it is best if it reflects the trend of the market. A short day follows the long day with its body completely inside the body range of long day. Just like the engulfing day, the tops or bottoms of the bodies can be equal. The short day should be opposite the color of long day. So here we can see there was a downtrend in the place. There was a big down move, and then next day the prices opened slightly higher than the previous day's close, and they closed within the body of previous day, but the opposite color. Similarly, here the trend was in up. There was a big white bar, and then next day prices opened slightly lower and they closed lower, but within the body of previous day's white bar. So bullish Harami. A downtrend has been in place for some time. A long black day with large volume occurred, which helps to perpetuate the bearishness. The next day, prices open higher, which shocks many bears, and many shorts are quickly covered. So that is the reason why the next day opens slightly up, and also it keeps going up, causing the prices to rise further. The price rise is tempered by the usual latecomers, seeing this as an opportunity to short the trend. They missed the first time. So somewhere that move of up move is restricted because some of the people who still believe that trend is downtrend, they will short at the slightly higher of the day. If the volume on this day has exceeded the previous day, which suggests strong short coverings, a confirmation of the reversal on third day would be provide needed proof that the trend has reversed. So even next day, if prices keeps moving up, so even the people who have taken the short position previous day, they will also cover up, and next day prices will push more higher. Then the bearish Harami. An uptrend is in place and is perpetuated with a long white day and high volume. The next day, prices open lower and stay in the small range throughout the day, closing even lower, but still within the previous day's body. In view of this sudden deterioration of trend, traders should become concerned about strength of this market, especially if volume is light. It certainly appears that the trend is about to change. Confirmation on third day would be a lower close. So this is the bearish Harami. These are the examples. Like here, we can say there was a downtrend in the place, and here this pattern appears more like bullish Harami. And then from that day onwards, the trend has changed to up. Similarly, here there was a strip uptrend here, and then at the top of the move here, we can see there was a bearish Harami, and then from that day onwards, there was a short downtrend, and the prices consolidated and moving in the sideways pattern. These are the classical examples of bullish and bearish Harami. So we stop our video here.
In our next video, we will cover reversal candlestick patterns, few more patterns such as hammer, star, doji star, etc. So keep watching this space. Thank you. Thank you for watching this video. Please like it, subscribe it, forward it to your friends and relatives. Thank you very much.